We have a smattering of interesting macroeconomic data points due in the week ahead, including US consumer confidence on Tuesday the 28th of September, UK mortgage approvals on the 29th, China's latest purchasing managers indices on the 30th, and Japan's main business sentiment indicator, the Tankan, on Friday the 1st of October. But the main macro event of the week could just be the weekly American oil inventory data. As usual, the US Energy Information Administration will publish this on a Wednesday, so on this occasion that means the 29th of September. As the US economy has emerged from lockdown and started to grow, demand for energy has gone up, demand for gasoline and cars and trucks in particular. As a result, America's stockpile of oil has shrunk down to just 424 million barrels, excluding its strategic petroleum reserve. That means US oil inventories are down 15% year on year and down 22% from their June 2020 pandemic-driven all-time peak. Note also how supply is not growing a lot even as demand recovers. The number of active American oil rigs is now 503. Now that may be double what it was a year ago, but it's still only half the 2018 peak and barely a quarter of the 2014 zenith when shale oil and gas production was roaring higher. Yep, those shale oil fields are yet to really pour on the supply, even as oil prices trade near $70 a barrel and natural gas challenges the $5 per British thermal unit mark for the first time since 2014. In August, shale oil output was up just 2% year on year and natural gas just 4%. It could be a function of economics, but it could also be a function of political pressure, given the Biden administration's fiercely anti-fossil fuel stance. Although, I do note that the president has been calling on OPEC, Russia and their allies to increase production to dampen the oil price. Surely that's a case of someone wanting to have their oil and burn it at the same time, if you'll pardon the expression. Anyway, this all matters because if oil and gas prices stay high or keep rising, well, that could challenge the narrative that inflation is transitory, at least that's how central banks currently pitch it. And higher prices on the petrol station forecourts could knock a bit of a hole in consumers' wallets and purses too, unless they get some meaty wage rises. So keep an eye on the trend in America's oil stocks, especially as OPEC and Russia seem keen to only increase their output really very gradually. Meanwhile, a select number of companies are slated to update their shareholders on trading in the coming week. Names which may be of interest include the following, although do please note that some of these dates could yet be subject to change. United Utilities and Medica on Monday the 27th of September. Ferguson, Smiths Group, AG Bar, Pennon, Animal Care and Hotel Chocolat on the 28th. Snack and sandwich seller SSP on the 29th. And Renishaw, Boohoo and Go Ahead Group on Thursday the 30th of September. But the company which could just cause the biggest fuss in the week ahead is Next. The FTSE 100 retailer is due to report its first half or interim results to the end of July on Wednesday the 29th of September. As I record this, Next shares are up by almost a third over the past year and they're hovering just below their all-time closing high of £83.20 that they reached in May. Strong online sales, profit forecast upgrades and the payment of special dividends, with the promise of more to come, are all helping sentiment toward the stock. The last upbeat update from boss Lord Simon Wolfson came in the form of July's second quarter trading update. At this stage, he upgraded full year forecasts to 2022's January end as follows. First, he upgraded full price sales growth to 6% from 3% against 2 years ago, and the initial guidance of flat. Note that in the first half up to 17th of July, total online sales were up 56%, retail sales were down 43%, to mean full price product sales were up 9%. Throw in an 11% drop in finance interest income, and full price sales were up 7.8%. All of those figures were against 2 years ago. Note therefore that Lord Wolfson's guidance assumes a slower rate of growth in the second half, no doubt in no small part due to the tougher base for comparison. Second, the chief executive upgraded pre-tax profit guidance to £750 million, up from £720 million and the initial guidance of £700. That even includes the unplanned repayment of £29 billion in business rates relief. They will again be the headline numbers to watch. The final point of interest will be the dividend. Alongside that second quarter statement, Next announced a plan to return £240 million in what it calls excess cash to shareholders. It paid out £140 million, or 110p a share, on the 3rd of September, and it said it would pay out the rest, 100 million, or around 78 pence a share, following the Christmas trading update that's scheduled for January 2022, assuming that all is still going to plan at that date. Next also noted it would then look to resume ordinary dividend payments in the year to January 2023, when analysts and shareholders may also ponder the resumption of share buybacks as well. Note that over the last decade, Next has paid out £2.2 billion in dividends and £1.9 billion in buybacks. Those buybacks have taken the share count down from 181 million shares to around 127 million, effectively increasing a shareholder's stake by a third had they sold no stock at all. I hope that you and your families are all in good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.